Good afternoon, it's Jeff Christian. It's Friday, the 27th of August, about 2:40 in the afternoon in New York. I'm going to talk to you about what matters today, sort of refocusing on the fundamentals of the market and the macroeconomic environment that are important to precious metals and trying to not be distracted by the carnival noise. So I want to talk a little bit about gold supply and demand. Some people who have posted notes have said, hey, you know, you're right, these other people aren't talking about supply and demand, and those things probably are actually important to gold. So my hope is to talk about gold supply and demand today and run through some charts that will show you some information about what's going on: mine production, secondary recovery, fabrication demand, investment demand, and central bank transactions. And then hopefully next week I can do some silver supply and demand work, market depending. I also want to talk about the dollar and gold's purchasing power, both in the period prior to the dissolution of the Bretton Woods gold dollar international currency regime and after that. A lot has been made about the decline in the dollar's purchasing power since 1971, 50 years ago this month. And it is true, the dollar has fallen. But I think that the people who are nostalgic for a gold standard really are ignoring the reality of the dollar's purchasing power decline in the United States from 1800, the start of the Republic, till 1970, and also the purchasing power of gold. So I have a variety of slides. It's actually just 2 data point series, but I have like 5 different slides showing it in different perspectives, and then a table with the numbers. And I want to talk a little bit about that. Then I'll wrap up with a market update and everything. Let me start by making a clarification. In one of our recent presentations, I talked about a company that had bought about, I don't know, 29,000 ounces of gold, $50 million worth of gold, as a way to diversify its cash reserves against a, quote, black swan event. And I said, you know, that's actually not in all that unusual. And one of the things that CPM group analysts always wrestle with is, we know this stuff like the back of our hands. In fact, we know the stuff as the back of our hands. We're constantly steeped in it. And a lot of times we use shorthand or we jump from thought to thought, not realizing that the people that we're speaking to don't necessarily know all the minutia, and we can confuse them. So I confused some people. I said, look, actually a lot of companies have always used gold as a diversifier for their cash reserves. And then I said how some gold and silver producers had used gold and silver as cash reserves 2000, 2001, 2002, 2003, you know, early part of this century. And I said, you know, I made the comment that one of the questions that we always have is why more precious metals companies don't use gold and silver as a place to park some of their cash reserves, because it would be beneficial to their share price probably, and I think their shareholders would like to have that double whammy of exposure to gold and silver. In between talking about the fact that a non-precious metals company had parked $50 million of gold, of its cash reserves in gold, and talking about the producers, I didn't say, well, I did say, but maybe I didn't say it that clearly, that the reality is a lot of companies that are not involved in precious metals actually use gold as a way to diversify their cash reserves. This company is not unique. The other thing I want to clarify is the microphone. We have one of the best microphones available right now, and people have said, gee, you ought to buy a new microphone because you're hard to understand. I'm hard to understand because that's the way I talk. I'm also hard to understand perhaps because of the computer that we've been using. We're looking into ways to improve this. It's not the microphone. This may be a little bit better because we've been tweaking some of the things in the meantime. So that's the schedule for today. Got a couple of the pieces of dirty work, back work out of the way. So gold supply and demand. I've got a number of slides here I'm going to run through. They're all from our gold yearbook, which came out in March. You can buy it on our website for $160. And not only can you see the charts, perhaps better quality, but you can also read the text that explains them. This is total gold supply going back to 1973, because the people who were asking about it wanted really a long dated version. And you can see how after the gold price rose, the black part is market economy mine production. The gray part is what we used to call centrally planned economy, exports into the market economies. And then it became transitional economies into the market economies. And it's very small. There still are a few of those countries, but a lot of that stuff has actually been incorporated in the market economies. China, for example. I think we still keep Russia as a separate because we don't have good data on Russian fabrication demand and secondary recovery. And if you just add mine production, but you don't look at the total national market account for gold, you're going to skew your global data. So we still exclude a few countries. And then the red part is secondary supply. When I took over the J. Aaron Research Department in 1980, no one was publishing secondary supply data for gold. And you had actually on the fabrication side, the two companies, Consolidated Goldfields and J. Aaron, that published gold fabrication demand data, had negative 30 million ounces of jewelry demand in 1979. And we said, what do you mean? Well, 30 million ounces of gold was refined from scrap, more scrap jewelry, more than was used in manufacturing new jewelry that year. So we started working on it, and after a couple of years, we were able to start add secondary supply to our supply data. And it's been there ever since, and everybody has done it. So you can see that mine production was kind of flat in the 70s, and when the gold price rose in 1979, 1980, and stayed high, it didn't stay at $600 on an average price as it was in 1980, but it stayed above 300 for most of the time until 1999. And that prompted a massive expansion of gold mining, primarily outside of South Africa. In 1980, about 72% of gold production was in South Africa. The United States had one gold mining company, Homestake Mining. Australia produced less than 1 million ounces. And you had this boom in non-South African mine production. And it took mine production from about 34 million ounces a year to about 68 or 78 million ounces in 2000, 2001. We then had a decline because we had entered a 5-year down bear market from 1997 through 2002. And we had a decline in mine production for about a decade into about 2008. And then it started rising again. It's fallen in 3 of the last 4 years. Last year was exacerbated by the pandemic. It's up a bit this year, but it's not back to 2019 levels. And the same is true on total supply. You saw total supply rise, and as the price has risen and demographics have shifted in China and India and Thailand and Indonesia and Malaysia and the rest of the world, you've seen an increase in secondary recovery of scrap. You've also seen an increase in secondary recovery from electronics, partly because governments around the world have said, hey, you have to recycle the end-of-life electronic equipment that you're producing. So we've seen total supply well over 120 million ounces, really for the last 15 years, 14 years. It's come down a little bit. Our expectation, by the way, for the next 10 years is that it comes down a bit more, but it basically stays above 120 million ounces through the next 10 years. So we see total supply leveling off, but we don't necessarily see a sharp decline. Reserves, people talk about how the world's running out of mineable gold. No, reserves today are roughly 30% greater or larger than they were in the late 1980s. And we've seen, you can see the reserve base, which goes through about 2008, rose even more sharply. Resources are a little bit harder to measure, and these exclude what are believed to be the largest resources in the world in China and in the Russian Far East, which is likely to be the source for a lot of gold mine production increases over the next 10, 20 years, which will largely be done by companies that are not listed on the TSX or the New York Stock Exchange or the London Stock Exchange. So there's going to be a shift in the ownership of gold mine production, and there's going to be growth in gold mine production. Exploration expenditures remain low. It's not that mine production is falling because we're running out of gold. It's mine production is falling because a lot of companies haven't been spending a lot of money on exploring for new properties and developing new properties and expanding existing properties. When people say, well, we haven't found any large gold mines in recent years, A, they're wrong, we have, but B, they don't understand that, and these are nominal expenditures. You know, the amount of money that the mining industry is spending on looking for gold has plunged over the last decade and remains very low. The gold part at the bottom is the amount of mining, hard rock mining exploration dollars that's allocated to looking for gold. And these are nominal. If you adjust it for inflation, the decline has been even more dramatic, and the reduction in the low level of real money, you know, adjusted for inflation, that's being spent on exploration has been low. And the data is also not adjusted for changes in methodology, which makes current levels seem higher than they are relative to the earlier levels if you use proper statistical measuring devices and adjusted for changes in methodology. So as I've said before, I'll say it again, and I'm sure I'll be saying it until the day I retire or die, or both. It'd be bitter if I die on the day I retire. The decline in mine production, insofar as there is one, and the decline in discoveries of new properties is not a function of geological realities. It's a function of human activities and practices. And the fact that the humans are not spending as much money on it. And in addition to all of those things I just said, a lot of the money that's being allocated to exploration is not being allocated to grassroots exploration, such as was found in the past. A lot of it's being spent on computer modeling, looking at past discoveries and saying, where are there rock formations similar to past discoveries, which is terrible for a couple of reasons. One of which is that every major gold discovery in the last 160 years has been a geological anomaly. You don't find large new gold mining districts in places that look like past large gold mining districts. They keep finding new ones. That was true in California in the 1840s. It was true in Canada several times over the last 160 years. It's true in South Africa. It's true in Australia. It's true around the world. So if you look at a computer and say, where was gold discovered in the past geologically, we'll look there. You're not going to find the big properties and discoveries like you did in the past. So there's a lot of structural issues that are man-made or human-made in the exploration business, gold mining exploration business. Cash costs, meanwhile, and total costs. The total cost is the top line. You see the average quarterly total cost is below $1,000, or is below $1,100, and it has been below that really since 2014, since the bear market, the cyclical bear market set in gold. So, you know, we saw one of these guys this week say in the same presentation, he said, you know, these mining companies are starved for cash. They're barely any of them are making any money. Most of them are not even breaking even. And then like 2 minutes later, he was talking about the record profits that they're having. They have enormous profits on average. There are some companies that are losing money, But if you look at, on a sustaining cost basis, cash cost basis, and you add that together, you come up with the total cost, all in sustaining costs, as the mining industry calls it. It's less than $1,100. And with the gold price now around 1820 as I speak, that's a really good profit margin. Or as Peter Monk said in 1982, 83, when he decided to get into gold mining and created Barrick Gold, I've got to get myself a gold mine. Turning to fabrication demand, it has been flat for much of the last several years. I want you to pay attention to the sharp increase in jewelry demand. And the blue part is jewelry in developing countries. The red part is jewelry. The use of gold in the manufacture of jewelry in developed countries. We measure where gold is used, not where the jewelry is bought. And you can see a big shift in manufacturing away from Italy, the United States, and other industrialized countries to Thailand, Indonesia, India, and other countries in the developing countries. But I want you to pay attention to that sharp increase from 1980 to 2000 in jewelry demand, the use of gold in jewelry. And then since that time, it was kind of flat it came down for a decade, and now it's been kind of flat. It fell off a cliff in 2020 because of the lockdown. It's coming back very modestly in 2021. But let's look at the longer term drivers. Now, the chart on the right, on the left, shows you sources of demand as a percentage of total supply. And you can see jewelry demand is in fact the largest off-taker of gold. And it's jewelry use because the jewelry is not consumed. It's used in the manufacture of gold, jewelry. The gold is used in the manufacture of jewelry, and that gold is recoverable, and it is recovered. Not all of it, but a lot of it's held in jewelry form. Industrial, much lower. Investment demand, more volatile. And if you looked at that investment demand chart and you compared it to changes in the gold price, you'd see a very close overlap. It's the changes in investment demand that really drive changes in gold prices. And when investment demand is down there lower than 20%, you tend to see lower gold prices. And when investment demand is 20 to 40%, you tend to see higher and rising gold prices. The chart on the right goes back to that jewelry. You can see as the gold price was flat to lower from the early 1980s into around 2000, jewelry demand rose very sharply. Now, it wasn't all a function of price. There was also changing demographics in India, in China, in Thailand, and in a number of other places. There were rising income. There were other factors that were there. But the reality is that jewelry demand, as is industrial demand, are price sensitive, price elastic. And as the gold price was flat, jewelers were using more gold per piece of jewelry, and consumers were buying more gold jewelry. When the gold price rises, as you saw 2000 to 2011, jewelers use less gold per piece, and consumers buy fewer pieces of gold jewelry. So jewelry demand is very important as an off-take source to take the consumption or the use of gold and take that out of the gold bullion market and put it into the gold jewelry market. But it's not a major driver. The price is more important to levels of jewelry demand than the levels of jewelry demand are to the price. Central banks have been buying gold on a net basis since about 2008. They are very price sensitive, as I've said in weeks past. They pulled back in 2020 because the price, investors bid the price up, and they said, we're not going to buy. We are seeing stronger demand this year. We have it here around 6 or 7 million ounces that we were looking for total. It's probably over 7, it is over 7 million ounces in total on a net basis through July. And it probably will be closer to 10 for the full year. So they're actually buying a little bit more gold. while investors are buying less gold. And again, these charts are from our gold yearbook from March. So we have investment demand in 2021 a little bit higher than it probably will turn out to be, and that will be compensated for by lower prices. My last chart on gold supply and demand. There's been about 5.8 billion ounces of gold mined since antiquity. Most of it you can see here since 2000, or since 1900. So really, since 1900, you've had about 95% of the world's gold that's been mined. And we have a pretty good idea where about 95% of that is. A big part of it is in private stocks, nearly 2 billion ounces, another billion ounces in central banks and monetary authorities. A lot of it's in jewelry and jewelry form. And then there's maybe 10% of it that's been lost. And I've seen some people referring to these numbers in recent years. Now I want to talk about the dollar and gold's purchasing power, 1800 to 2020. There's been a lot of talk about how the dollar has lost a tremendous amount of purchasing power since we went off the Bretton Woods dollar gold standard. And that was in August of 1971. Here's 1971. And yes, the dollar has lost an enormous amount of purchasing power since 1971. But this is 1800 and this is 1971. And look at what's happened to the purchasing power of the dollar under the gold dollar standards that we had basically for almost all of the time from 1800 to 1971. We suspended it during the Civil War. We suspended it during World War I and again during World War II. But most of this time we had a dollar gold standard. And the dollar's purchasing power set at $1 in 1800, just for comparison purposes, kind of fell during, I guess that was Andy Jackson's Depression, rose then after Andy, came back down during the Civil War and all, rose again, came back off. And by 1970, it was off something like 58%. I'll show you the data after these charts. So the fact that the dollar's purchasing power is about 20%, 14% of what it was in 1800 today is true. The fact that it fell sharply after 1971 is true. But the idea that it was somehow stable between 1800 and 1970 under those gold standards is false. It actually had fallen sharply, really from World War II onward. And for comparison purposes, this is gold 1800 using the same US PPI to deflate it. And we used the PPI because the CPI wasn't around for most of the 19th century. I'm not sure when it came into being, but Roy Jastrom in his book, The Golden Constant, in the absence of CPI, used the PPI. And we have built the data off of Roy's work ever since he published that book in the 1970s or early 1980s. But this is gold. And you can see, at one point it was down, we indexed this to 2020. So you can see here. But you can see that gold went from $600 on an index basis to $400. It lost a third of its value. It gained it back, and it was up a third. And then it fell again, and then it rose again. And then it fell, and it fell, and it rose, and it fell. And this is 1971 right here. Once the dollar gold link that governments imposed at $35 an ounce was severed, gold prices adjusted upward. I want to show you a couple other things. This is just the same data, real and nominal gold prices, and this is the producer price index just that we use, just so you can see how it is that we come to the real gold price from the consumer price, because that seems to confound some commentators in the market. And then this is the real dollar and the gold dollar price, 1800 to the present. And you can see that the decline, they both declined during gold standard period. And that's very important because people will tell you that gold purchasing power is stable, they're wrong. And the key, well, I'll get to the key in a second. Here's the data. The real gold price from 1800 to 1970 fell 75%. That's because it was fixed to the dollar. Inflation was going on year in, year out, and the real price could not adjust for the inflationary pressures. So the real price depreciated and deteriorated because the nominal price was fixed. From 1971 to 2020, after we severed that fixed dollar gold price ratio, the real price of gold has risen 882%. Pretty good investment. The real dollar purchasing power, you can see here, was off 59% from 1800 to 1970. Not particularly sterling performance. And then from 1971 to 2020, it fell another 80%. So it's down to about 20 cents in $1,800 terms. $1 in 1800 is equivalent to 20 cents today. So the dollar has deteriorated. Gold has actually appreciated since we got rid of the dollar gold standard. Good thing for gold investors to remember. Now, the value and cost, the reason they both fell is because they both are money or quasi-money. And both of them are assets that people can charge interest on, loan it out, charge interest, and other people and earn interest. And that is a very important factor. And this is nothing new. Adam Smith wrote about this in The Wealth of Nations in 1776. Now, I know most commentators about gold and the dollar and the coming crash of the dollar and the coming crash of the Fed on the internet have never read The Wealth of Nations. But it's been there in the canon of Economics 101 since at least 1776. It's nothing new. If you can charge interest on something, you depreciate it over time. And the value of money is depreciated both by inflation, the rise of the value of other things at times, and the fact that you're earning interest. And there are two key factors there. One is that, yeah, anything that you can earn interest on, you're going to depreciate over time. And going back to Adam Smith, he said, wealth is not measured by the amount of gold and silver and currencies you have in your safe. Wealth is measured by the investments you've made in productive economies that can create new wealth, because gold and silver and money and currencies all depreciate over time. And your only way to preserve your wealth in the face of that ongoing depreciation of currencies is to take some of your currencies and invest it in productive units that can make more wealth. That's the same thought that drives Warren Buffett to say, I would rather invest in a gold mine than gold, because gold has no return for me other than capital appreciation, but a gold mine makes more gold day in, day out, if it's run properly. So that's one of the factors. The other one is that without the capacity to borrow and to charge interest and to earn interest on money and quasi-money, economic growth would be severely constrained. This is how severely constrained it would be. These are real GDP growth rates in various centuries and millennia. Is virtually zero from the year of our Lord to 1000, and it was less than 0.5% per annum until the 19th century. And it's real growth is fueled by credit and the availability of credit. It's fueled by a lot of other factors, including the Industrial Revolution and the creation of more productive machinery. But the Industrial Revolution and the creation of more productive machinery was fueled by credit availability, as was the age of discovery and the age of conquest from 1700 till 1870, 1890s, 1960, depending on which period you want to look. So the reality is that while we don't like the fact that earning interest on gold and silver and currencies depreciates the value of those assets over time. The reality is they make life a lot better and a lot more fulfilling and a lot healthier for everyone. So when you hear people say, you know, I want God's true money and we shouldn't be earning interest, et cetera, they want to go back to the years 0 to 1,000. Zero growth, I guess that's sustainable growth, and people dying of tetanus when they're 18. Market update. Here's real and nominal prices since they were freed to float in 1968. And you can see, yes, we're at record highs, even with the decline in gold prices this year from $2,000 last August on an intraday basis. We're at record highs in nominal terms. And those record highs are almost as high in inflation adjusted terms as the record high in 1980 and the record high in 2011. So our view has been and continues to be that we have a lot further to go in terms of real prices. Now, we've seen gold and silver rise in the last few days, and they've risen sharply today. And it's a little bit surprising to me because what the trigger was this morning, the release of some preliminary comments by Fed Chairman Jerome Powell, who's out at the Jackson Hole conference, Kansas City Fed conference in Jackson Hole, Wyoming. And he basically said, reiterated what he said before. I'm not worried about inflation. It's transitory. We will be tapering our monetary accommodation because the economy actually looks strong. And you've seen interest rates rise over the last 3 or 4 days. And you've seen the GDP figures for the second quarter adjusted slightly upward. You know, so there's signs of strength in the economy, even in the face of the rise of COVID and in the face of other factors that are going on. And so you're seeing the gold price rise. And when Powell said that, it was taken as a trigger for a massive sell-off in the dollar and a big increase in stocks and copper and gold and silver prices. Doesn't quite make sense to me. It's like the market is saying, oh, Jerome Powell's going to ignore inflation and inflation is going to get ahead of the Fed. But I suspect that the reality is that the Fed is not ignoring inflation. It's correctly reading inflation, and it will play its cards well. As I said a couple of weeks ago, they'll lean into the breeze of inflation. I think that most of what we're seeing is transitory inflation. By the time we get to August and next year, I think people are going to be talking about deflation again. But before that, like maybe on Monday, because Jackson Hole's just started. So they've got speeches all through today and tomorrow, not only by Powell, but by other people. I think that by Monday, you might see people saying, okay, wait a second, maybe we're misreading what the Fed signals are, and we will be seeing some tapering of bond purchases, perhaps as early as the fourth quarter of this year. And we will be seeing some monetary tapering in money supply, perhaps as early as the first half of next year. So I think that that's what's sort of going on right now, but we'll find out next week. And as I said a few weeks ago, I think September is going to be a very critical period of time for a readjustment of attitudes in financial markets toward the dollar, gold, equity markets, and interest rates. And I'm not quite sure how it's going to shake out because we've got a lot of moving pieces right now. I mentioned this book a couple of weeks ago, and I'm going to mention it again. It's a very good book, and we're working through it. And it's very interesting because it talks about the adversarial nature of some people's mindsets as opposed to the mediatory attitudes of other people. I helped someone write a book in the 80s called The Cooperative Edge, in which she looked at various corporations that have done very well by cooperating rather than competing with each other. And it's sort of the difference between a lawyer who is adversarial and treats every discussion in an adversarial way, looking to perpetuate the legal industry with more legal work, and a mediator who says, well, let's sit down and let's try to understand why each of us feels and thinks what we do and moving forward. And you can tell an adversarial mind, someone that's addicted to high conflict, because they're very abrasive, they're very dismissive of everybody else, and they like to assert the view that they know better than everybody else. So when you see somebody and they say, wow, you have a different view than I do, tell me about the rationale, the thinking behind your view, so that I can understand why you believe what you believe. That's a mediation type of approach. An adversarial approach is, you have a different view than me, but you know, I have a college degree, so I know more, and then they start name calling, and they start putting out memes about cartoons and shit like that. Now, that leads me to one last thing. Somebody asked me, hey, you made some comments about some market metrics that you look at that are very important. And some of these guys who keep calling you names and putting up posts about you and saying, hey, I think Jeff should debate me so that I can make him, make everybody understand what an ass he is. Some of those people don't understand this, and they would love for you to tell them what the metrics are. Leads me to an anecdote about Ron Paul. I talked a few weeks ago about how Ron Paul, for all of his career in the House, kept saying that the Fed and the Treasury ought to audit their gold. And when he finally had hearings on it in 2011, the Treasury said, hey, we audit it every year, here are the audits. And we've been doing a deep audit with assays and counting every bar and weighing every bar and checking the numbers against our bar lists. That took about 8 years and tens of millions of dollars. And he said, well, you guys never told me that. And someone from the Treasury said, well, you never asked. You never asked us if we have an audit. You never asked us if we audit. All you did was made public comments in which you called us names and said that we were buffoons that knew less about our business than you did as a hack doctor from East Texas. So if you had asked, we would have told you. But for 20 years, you didn't ask, so we didn't tell you. So I cannot imagine why I would teach people who don't know what they're talking about and continually call me names what they should know. It just doesn't make sense to me. Oh, it might be nice, you know, maybe I get a halo when I die, but there's no value for me in helping people who have treated me like garbage to understand that which they don't actually understand. That's their high conflict. We will be doing an open forum for our clients next Wednesday. You can go to our website and buy our yearbooks, the gold yearbook where those charts came from, the silver yearbook which I'll use as the basis for my silver supply and demand discussion when I get to do that, retail investment program, and an introduction to CPM Group. There's a variety of assets and free reads. There's a whole series of documents, presentations from the old silver summits from, I don't know, 2006, 2007 to 2014 or so. They're all there for free reads, where we go through a lot of the myths and misinformation that is concurrent in gold and silver and politics and the economic thinking, and we dispel a lot of those things. So you can go in there and you can read all that stuff, and then we don't have to waste our time talking about those things. We can focus on what matters. That's all I have for today. Have a good weekend. Enjoy yourselves, and I'll be speaking to you next week.